This is the S&P 500 over the last 30 years, and this is the fund you could have bought instead. In this video, I'm going to share one of my favourite index funds to buy. Hint, it's not a Vanguard fund. Hi there, if we've not met before, my name is Chaz, and I'm the Risk On investor. On this channel, I'm documenting my journey to building a £1 million investment portfolio. I'm also looking at ways to earn a little bit of extra income, because I'm currently not working, and I'll be sharing what works for me and what doesn't work for me. If that's something that interests you, please hit the subscribe button. It really helps out small channels like mine. Before we jump in, just a quick disclaimer. I'm not a licensed financial professional. The content on this channel is for educational and entertainment purposes only. If you need financial advice, please seek a specialist's help. So what is this fund in question, and why do I like it so much? So to understand why I really like this fund, you first need to understand some of my thinking about what I'm looking for. And that can be boiled down into a simple risk versus reward trade-off. If we look at this chart here, we can see that over the last 10 years, TQQ, which is a triple Nasdaq 100 leveraged fund, has absolutely crushed the Nasdaq 100, which in itself has outperformed in comparison to the S&P 500. So you might see this and just go, well, why don't we just go all in on the TQQQ? Because we've seen that it delivers really strong long-term results. And that's fine. If you're after just the highest return, you're going to have to accept some volatility. If we look at 2022, we can see that TQQQ actually had a drawdown of over 80% in that year. That's huge. And to put that into perspective, in the same year, Bitcoin, which also had an awful year, had a drawdown of less than 80%, peaking at around 78%. Now, I don't know about you, if I was sitting on a retired £1 million investment portfolio and I saw it plummet by 80%, I'd be pretty nervous. There's not many investors that can stomach that kind of level of drawdown. And it's drawdowns like that that cause investors to panic sell and sell out at the worst possible moments in the market. Now for me, the benchmark of a good risk-reward portfolio is a classic 60-40 portfolio. So that's 60% stocks and 40% bonds. Over the last 50 years, it's delivered about 10% less per annum than a straight S&P 500 tracker, but it's had lower drawdowns and a higher Sharpe ratio. Both of those are really good measures of how risky a portfolio is. But why would you mix bonds in with stocks if it gives you a lower annual return? And that's something to do with the sequence of return risk. So if we're to start drawing down on a portfolio, and we go through a really bad sequence of returns, a couple of down years, the longevity of your portfolio will almost certainly be a lot less than if you have some really good returns in the first few years of your portfolio. And that's why a lot of people use bonds or cash or gold as a hedge in their portfolio. So whilst the stocks deliver most of the growth, you want something that has a low correlation to that main driver of growth in your portfolio. And that's what the bonds do. So in times when stocks get really hammered, you hope that your bonds will stay flat or possibly even rise. And that reduces the maximum drawdown in your portfolio and smooths out returns over time. So what is this fund in question that I really like? It's called the Wisdom Tree US Core Efficient Fund, or NTSX for short, and that's a bit of a mouthful. So some of the first two questions I ask myself when looking at a new fund is what's actually in the fund and what are the fees like? So let's cover what's in the fund first. So the fund holds 90% of the allocation in the 500 largest US stocks. So this is effectively an S&P 500 proxy for 90% of it. But the magic happens in the last 10%. In the last 10%, the fund holds cash, but it uses that cash to buy 6x leveraged US Treasuries futures of an intermediate length of about 7 years in a ladder. So that means that when you buy NTSX, you're effectively buying a 90-60 fund, so 90% stocks, 60% bonds. Now you may have seen that doesn't add up to 100%, and you'd be right. Now remember our 60-40 portfolio we talked about earlier that has a really good risk-return trade-off? Well, NTSX is just a 1.5 leveraged version of that fund. So if you were to hold this fund as 100% of your portfolio, it aims to deliver approximately the same returns as a 100% stock portfolio on a given year, but smoothing out the returns. Now even better still, the expense ratio, because it only leverages the bond section of the portfolio, which is a very liquid market, is actually really low. The expense ratio per annum for NTSX is only 0.2%. Compare that to some popular index funds, such as Vanguard's FTSE Global All Cap Fund, which has an annual expense of 0.22%, and you'll see that you're potentially getting a much better risk-reward return for your fee than simply buying a global index fund. So what do I like about this fund? Specifically, I like the flexibility it gives. Now there's two ways that I can really see this fund being used in your portfolio. One is not what WisdomTree, the creators of it, intended, but the other is. So the method that wasn't the intended method from WisdomTree is if you just held NTSX as 100% of your portfolio. You'll see in the backtest I showed earlier, that's delivered superior returns in comparison to the S&P 500 over the last few decades. And even though it would probably cost you a little bit more to hold than an S&P 500 index fund, the annualized return more than makes up for that. But how do WisdomTree, who created the fund, recommend you use it? Well, they recommend you hold it as 2/3 of your portfolio. Because it's 1.5x leveraged, that means you're effectively getting the returns of a 60-40 portfolio with only 2/3 of your portfolio needing to be allocated. That means you've still got 1/3 of your portfolio you can allocate to other things to try and generate a higher return. Now maybe that could be that TQQQ that we were talking about earlier, or what appeals to me is potentially some kind of income element to the fund. So if you've got a portfolio you're using for retirement, you could allocate 2/3 to NTSX to generate strong growth in your portfolio, and 1/3 to an income fund. For example, you could use a covered call fund, such as JEPI, which seeks capital preservation but delivers a yield of about 8% a year. In that instance, if you had a 2/3 NTSX and a 1/3 JEPI portfolio on a £1 million investment, that portfolio would throw off around £27,000 per year in cash from the JEPI element, and then any further income that you needed, you could take from the growth portion of your portfolio. You could then rebalance that regularly and have a really strong growing portfolio that you could likely withdraw more than 4% from in any given year. The fund has also reached around 1 billion in assets under management. Now the reason I look at that when I look at funds that I'm buying is because small funds, particularly those that never really exceed about 50 to 100 million in assets under management, quite often after a few years, the provider that's created that fund will pull it from the market because it's not generating them enough money. But now the fund has hit around 1 billion, it's likely to stick around for a while yet. So that means, in my opinion, the risk of it being pulled from the market is quite low now. Now that all sounds really well and good, but are there any downsides to NTSX? Well, there's one big one in my opinion, and that's the lack of international diversification. So NTSX, as the name suggests with the US Core Efficient Fund, focuses the stocks section of the portfolio on US companies. Now that would have been fine over the last decade when US companies have outperformed the global funds, but the decade before that, the US underperformed. So between 2000 and 2009, in that 10-year period, the US underperformed in 7 of those 10 years. Now WisdomTree do actually have an answer to this. They've also created the NTSI instead of the NTSX. Now the NTSI has the stocks portion of the portfolio in international stocks excluding the US. So that means with the US making up about 60% of the global stock market, so we could hold 60% NTSX and 40% NTSI to have a 1.5x leveraged global 60-40 portfolio. Now NTSI has a slightly higher expense ratio, so your total expense for that portfolio would be about 0.224%, but that's still relatively low, especially when you're likely to have superior returns to many global index funds. Now unfortunately, only the US version at the moment can be purchased on Trading 212, which is the ISA provider that I use. So if you're happy not to have the international exposure for now, you can write to Trading 212 and request funds be added. So you could start with NTSX as your base, or even create your own international exposure using the funds that are available on platforms like Trading 212 if you wanted. Now if you don't use Trading 212, I highly recommend it as an ISA provider. It's who I use, and it's a fee-free platform. That means there's no platform fees and you don't pay any commission fees when you buy and sell. And even better, Trading 212 are doing a no-brainer offer at the moment where you can get a free share just by signing up and depositing £1 in an account. Even if you don't use the account in the future, you can just sell the shares and pull out the money. So if you don't have a Trading 212 account yet, you have the chance to win a share worth up to £100 at no risk to you. So I highly recommend doing that even if you don't plan on using them as your broker going forward. To have a chance to win the share though, you need to use someone's invite link, So I've put mine down in the description below if that interests you. When you win a free share, I'll win one too, so it's a win-win for both of us. Now I do also actually have a free beginners investing crash course. It's a 7-day email sequence that's completely free that covers some of the basics of investing. It covers topics like passive versus active investing, and it also covers more exotic investments, along with some case studies, including an example of how I made over 100% instant paper gain with an arbitrage trade. Now if that's something that interests you, I probably won't be keeping it free forever because I'm still building it out, but you can get hold of it for a limited time using the link in the description below. Please subscribe if you found any of this helpful. It really helps out small channels like mine grow and reach more people. And if you like the content you've seen here, you'll probably like my £1 million investment portfolio journey, and you can find the playlist for that here. You can also join the Risk on Investor community with links down in the description below, along with loads of other freebies and things that I found that you might find helpful. Thanks very much for watching. Bye.